Hey everybody, it's Scott, and I'm going to talk about personal investment performance, or also known as your PIP. I talked to a member today who wanted to know why their PIP was not as high as they thought it should be, and I went over their IFT history with them and did a little scrutinizing and figured out what was basically what was going on here for the most part. I want to talk about this, so I give you guys some inputs on how to make sure your PIP isn't too low, or and also talk about some ways you can help improve your PIPs. All right, I'm gonna go and go to this little presentation I have here, and okay, so these are the four most common reasons for low PIP. Uh, First one here is you might be comparing your most recent PIP against the wrong standard. Now, the reason I say this is because if your PIP might look like it's low, but the problem is you might, what are you comparing it against? Are you comparing it against what other people have, or what your PIP has been in the past, or what? What you really want to be comparing it against is what are the actual TSP funds doing over the same time period that your PIP is showing. Because when you're looking from a rolling 12-month period, like right now, we're looking from the April 1st, 2018 to March 31st, 2019 period. At the end of April, and once May rolls in, that 12-month period is gonna, basically April of 2018 is gonna roll off the back end of that 12-month period, and it'll go from May to April. So, and every rolling 12-month period, the TSP funds themselves are also doing things different as well, and um, yeah, you're going to see times where maybe your PIP will drop from maybe like plus 15% now down to like plus 5% or something in one single month. Yeah, it doesn't necessarily mean there's anything wrong with anything you're doing. It might just mean that the share prices, the stock fund share price particularly, have dropped a lot very recently, and you're very heavily invested in the stock funds. Not a big deal. Think in terms instead of how are you comparing? How are you performing relative to those stock funds instead? I'm gonna get a little that just a little bit more a little bit later here, but I want to move on here. Also, second good common reason is you're making bad decisions with your interfund transfer or IFT activity. Basically, you might be moving. You're making IFTs on the maybe on a bad day, or you're moving on the wrong, moving toward the wrong fund at the wrong time, or whatever. Or in some of these cases, you might be moving toward the right fund, but maybe the timing's bad or something. Therein lies the problem with whenever you do IFTs, you subject yourself to potential problems or complications with your performance. Again, I'm going to go into that a little bit more as well a little bit later here. Number three, your distribution might be too conservative when the stock funds are performing strongly. So, example, if the C fund, CNS funds, for example, and maybe they might be up at plus 20%, whatever, but the G fund has only done about 2 to 3% over the year. Uh, any amount of money in the G fund is going to water down your performance. And the less you have sitting long term in the CNS funds when they're performing that way, the less money you're going to have exposed to those stronger gains, and the more money you're going to have exposed to the funds that are not performing so well, which is the flip side of that. Or if you have too much money in underperforming funds, that's also going to water down your performance. The last one I want to talk about here is you're invested heavily in stock funds, and there was price volatility and or price declines. I kind of touched on that a minute ago, or a couple minutes ago, whatever. But again, this isn't necessarily a problem. The problem is your PIP might be low, but you're probably failing to compare it to what the stock funds themselves are actually doing. Hey, what's the best performing fund over that 12-month period? How are you performing relative to that? That's what you should really be thinking about. Now, don't think about how your account, what your PIP looks like compared to what your PIP looked like the previous month or any other previous month, because you have a completely different set of standards to work with every single time the PIP changes over to a different 12-month period. Okay, so speaking of these comparisons, I want to show you what you should really be comparing your PIP against. Yeah, most people never do this, but it's very simple to do. I'm going to show you exactly how to do it. I'm going to go to the TSP website, and this is the TSP homepage, of course. Very simple. All you have to do is right here where it says in the investment funds section, right where it says monthly returns, I'm going to click that. And what you have here is a 12-month period. So from April 2018 to March 2019, this is the 12-month period we're working with as far as our PIPs are concerned. What you have here, last 12 months, it shows what all the funds are doing over the last 12 months. Particularly, we're interested in the GFCSI funds. I don't want to go into L funds because, like we talked about in the past, we're not fans of the L funds in our group. That's a whole nother can of worms. I don't want to get into that here because the point here is if we want to know how our PIP really is doing. I mean, just because it's a number, it doesn't look like it's very high. Well, how does that number look compared to what you see here? That's what you should really be looking at. Okay, I just want you to see 2.92% for the G fund, 4.63% for F, 9.48% for C, 5.13% for S, and I fund was minus 3.64% over the last 12 months. Now, every time a month rolls over, what happens is the top month here, in this case April, once the month of May comes around, what's going to happen is April is going to roll off this 12-month period, and then April 2019 is going to come into the bottom end here. So what we're really doing here is comparing, all right, what's C fund done in April of 2018, and let's just say CNS, if we're focused on those two funds. They didn't do too much in April of 2018. You see plus 0.38 and plus 0.28% respectively in April 2018. So if those two funds do anything better than those amounts in April of 2019, your PIP is going to go up, assuming you're 100% buy and hold C and or S fund investor. Now, there's going to be other times though where wait till the end of 2019, actually beginning of 2020, you have some monster gains here for the CNS funds back in 2019, January 2019. So we have an extremely strong standard to compare against once January of 2020 comes around, because in order for your PIP to not fall after the end of January 2020, the C fund is going to have to perform more than 8.01% positive in that single month, and the S fund is going to have to outperform a monstrous 11.64% month. That is a gigantic gain in a single month. That's more than a whole year worth as far as average. So don't expect that to repeat itself in January of 2020. More than likely, it's going to, even just 2 or 3% is still more than healthy enough for a single month. Now, let's just say the S fund does gain 3% in January of 2020. Well, once that does happen and this 11.64% rolls off, guess what? If you're 100% S fund buy and holder, the whole time for the between that whole period from, let's just say, December of 2018 through February of 2020, once that January 1919 part, the 11.64% gain from the S fund rolls off the back end and it gets replaced with a 3% gain, your PIP is going to drop by more than 8%, more than 8.5%, even though you've not done anything wrong, and you actually had a good month of gains. Problem is what fell off the back end of it, and that's what most of you guys are not understanding. And I need you guys to understand this, so you don't get so depressed or frustrated that your account's not doing what it should. Maybe it is not doing what it should be, but there's a lot more to the situation here that you need to pay better attention to, and you really might not be in as nearly as bad shape as you think you are sometimes when you're wondering why your PIP is so low. We can get into that more, and if some of you guys are really wondering, well, hey, you think you're doing the right things, but maybe your PIP is still low, hey, get in touch with me, and I'll go over that information with you. And I don't need to know what your account balance is or anything, or all I need to know is what days you made what days you did IFTs, what your distribution was prior to your IFT pattern or your histories, and then what your IFTs have been over the last year. That's it. I can figure out the rest from there just using baseline amounts of like just a $10,000 balance, and come up with an easy answer about what your account's actually been doing and what the stock fund or what all the different TSP funds have done over the same time. As you see, I can just get the TSP funds performances right here on this page without even trying. But there's a little more work involved looking at personal PIPs or figuring out why, what happened in IFT activity perhaps that might have contributed to some problems, if there even was some. But again, I can always go over that with you at some point in time if you get through this presentation and you're still not quite sure what's going on with your account. All right, I'm going to go back to the slideshow here and show you a little bit more particular individual in the group who I talked to again. This was their IFT activity over the last year. They were okay. I only looked at these three interfund transfers. They did one on March 13, 2018. The share prices on that particular date are not relevant to us. Where they were distributed at the end of March 2018 is what is relevant to us, because once, the last day of March sets the baseline for the start of April, or for April's performance to compare against. So, yeah, April of 2018 to March of 2019, as I mentioned already, is the 12-month period we're dealing with. So, with that in mind, the individual basically started the PIP period, the current PIP period, with 50% in the C fund, 40% in the S fund, and 10% in the I fund. On June 8th, they did an IFT and changed their distribution from 50-40-10 to 25C-75S. And then in October 24, they did yet another IFT and switched from a more heavily S-biased distribution to a more heavy in the C fund by going 70C-30S. And their actual PIP is in the ballpark of plus 4.56% as of right now. Or at least that's what my calculations come out to based on this information here. So now the individual thought that this PIP was a little too low. Again, what are we comparing it against? Are we comparing it against what it was, the same individual's PIP was the previous month or a couple of months or whatever before? Or are we actually going to compare them against the TSP funds? All right, well, I'm going to clear that up here in a second. And I'm also going to explain a little bit about how this individual ended up ultimately underperforming both the C and S funds, even though pretty much the whole time, the entire year, they were in mostly nothing but the C and S funds. And these IFTs are what actually did the person in. So I'm going to show you this here. Okay, I don't care about the GNF funds. I should have just deleted those columns, but anyway, these were the actual share prices on those particular dates. So the baseline price for April, as far as the CS and I funds are concerned, this is what the baseline standard is for us to work with. And ultimately, the end of March 2019 is what they resulted in, and that's where you get the CS and I funds 12-month performance from. These are the exact same numbers that you saw on the TSP page, and those are derived directly from dividing this number here by that number, and and the same information on each subsequent column. Okay, so plus 9.48% for the C fund versus, and then also plus 5.13% for S fund, and negative 3.64% for I fund. All right, so what really happened here with this individual? As you see, they're plus 4.56%. It underperformed both the C and the S funds. Now, I'm going to go into a little more here with how did they possibly underperform both C and S when that's all they were really even invested in the whole time. Okay, so what really happened here, I'll come back to here. Okay, when they were originally at 50, 40, and 10, they had more of their money in the C fund, which underperformed the S fund at the time, and they also had a little bit in the I fund, but and the I fund, as you see, did not do so well. I mean, it was still in the positive and in the green over that period of time, but didn't come anywhere near what the C and S funds did. Ultimately, not exposed enough to the S fund and exposed too much to C fund kind of slowed him down a little bit. If he'd been invested 100% in the S fund, then that particular point in time he would have had a 8.09% performance, at least as far as that a little over 2-month period was concerned. But on June 8th, they did in-fund transfer and went more heavily into the S fund. Now, what happened with the CS and they were in the C and S funds the rest of the time, no I fund. So now let's look at specifically the C and S funds over these periods. Once they were more heavily in the S fund, what happened here? The S fund underperformed because October happened. Everybody was panic selling in October and creating what ultimately ended up becoming just enough to be called a bear market. Not a very justified bear market, but it was a bear market nonetheless. Prices are working their way up from there, but at that point in time when you did the IFT, as you see, the S fund lost a lot more than the C fund at the time of the IFT. So lost out on 2.5% or so of gains here by virtue of having a little more in the C fund instead of S, when 100% S would have given them that extra 2.5% gain. And then losing a good almost 7%. Looks like 6.75% in that ballpark by being more heavily exposed to the S fund. That in and of itself wouldn't have really been a problem, but the fact that he had already been underperforming the S fund, because you're basically changing the standard that you're comparing yourself against. Compare yourself against one individual TSP fund. That's all that should matter to you. Compare yourself against the C fund, or compare yourself against the S fund, or whatever it might be, and don't compare against anything else. Which one are you trying to keep up with or beat? Now, I will say if you're 100%, I'm in kind of a sidebar here. If you stay in some combination of the CNS funds, long term, don't do any IFTs at all. Any combination of the CNS funds, it doesn't matter if it's 90C, 10S, 50C, 50S, 10C, 90S, whatever the case may be, if you're staying in that same position for the entire year, I guarantee you, your PIP will always, 100% of the time be somewhere in between what the C and S funds' actual performances are over that same point in time. So if you had some combination of CNS the entire year, And with these numbers you see here, then your PIP would have been somewhere between 5.13% and 9.48%. If you were 100% C fund over the year, you would have had a 9.48%, or roughly that amount. Contributions, if you're still contributing, will factor in here a little bit. It might be just a little bit higher, might be just a little bit lower, but it's going to be in that ballpark. If you were 100% S fund the whole time, you would have been around 5.13% for as far as your PIP is concerned. So this is where having some diversification actually can help you, because if, let's just say, you're not invested, maybe your money isn't focused on the right fund, maybe the one that is, you're not focused on the one that's performing the best. Something else, like let's say the S fund versus a C fund here, it's you'll still have a second baseline to outperform, and as the time goes, you'll continue to be somewhere between the two over the longer term. Now it's a guarantee you won't have as strong a performance as the strongest performing fund, but it's also a guarantee you won't have as weak a performance as the weaker fund. And that's part of the problem with overly diversifying your account too. I'm going to go into that here in a couple slides here, but ultimately, you don't want to put too much of your money into an underperforming fund, but you don't you want to try to be as focused as much as you can on the fund that is most likely to perform the best as well. But as far as corrections are concerned, like what happened in the fourth quarter of 2018, S fund was the worst performer at the time. Now on the way back up, it's performing the best as well. So constantly moving your money around is going to open up the door to potential problems. You might possibly outperform if you make the right moves at the right times. You actually can get a better performance than what you see here. There are people in the group who are reporting even like 20% pips right now because they made very well-timed moves and made the right they went to the right funds at the right time. Can they do it with consistency? Well, I sure hope they will. As long as you make good, smart decisions, like when and why you're making your moves, it can work out for you. But anytime you do make a move, you always open the door to risk of underperforming. And that's why when you swing trade, the vast majority of people who do swing trade actually underperform the same funds they're trying to beat. But again, I'm a swing trader by nature. I'm not going to discourage swing trading, but if you're going to swing trade, you have to know that, as much as you can outperform, you can also underperform by quite a bit. And even though this individual here wasn't actually swing trading, they were still moving their money around from one fund to another. Ultimately, it was one stock fund to another stock fund, but it was the same effect here. So ultimately, they ended up underperforming the same two funds they were dealing with. But coming back here off that long sidebar there, okay, so they lost money here, and then they went back to C fund, I believe, on 329, or actually 1024. Yeah, 70C, 30S. So when it went back more heavily into the C fund, now they had more money exposed to the C fund, which didn't perform as well as the S fund, and not enough in the S fund that when it was performing better. So every single time he was basically a step behind the process. He had the right, well, I can't say he had the right idea on this, but because the individual did say they were mainly moving because of their PIPs their PIP being low, and they were trying to increase their PIP, so they would make a move because of their PIP. Wrong idea. Do not move your money because of Do not move your money just because your PIP is low. You want your money to be invested where it's going to perform the best. So don't move your money to what already has been taking place. Like maybe you see the C fund performing better right now. Don't move your money to the C fund just because you see the C fund performing better right now. Know instead what factors into what's going to make that fund or one fund or another perform better than the others in the future. What conditions do we have to work with? What conditions are most hospitable to which fund? And the more you learn about that and get a better understanding of what kind of stocks or bonds, for example, are affected by what conditions, the more savvy you're going to become to knowing where to put your money and have it in the right time at the right place. You don't have to be a swing trader to outperform these funds either. You can stay 100% in a stock fund the whole entire time, your whole entire 30+ year career. You can stay 100% in the same fund. Maybe it's the best performing fund. Between your dollar cost averaging from buying more shares whenever the price drops, that's going to help you out. Scotty Cox, one of our group members, he's a long time buy and holder. He's always 100% S fund right now. Last time he ever did an IFT, if I remembered, I'm going to need Scotty's help on this one. I can't remember when he said he last did an IFT. It might have been during the Great Recession period. I think he went from 100C to 100S, or I'll have to dig that up. But he's actually outperforming the S fund over the same time frame. Why? Because he's using the dollar cost averaging. Every time we have a drop, he's still adding new contributions, and when those contributions come in, he's getting increasingly more fractional shares of S fund added to his balance or to his existing share count every time the price drops. So then when the price does go back up, now he has more increasingly more shares to work with after with these drops to get gains from. So that's one of the ways you can perform very well. Now also, another way is you can just stay 100% S fund, and then maybe the conditions change where C fund and or CNI fund are going to have better conditions than the S fund. And so at that point in time, you decide, hey, they aren't performing better right now, but I think they're going to, and you move your money toward the C fund. And maybe the C fund does does perform the best based on the condition changes. Then when you're doing this kind of thing, if you do it with consistency, you actually can outperform all of the funds long term. But again, anytime you move your money around, there's always a risk that you're going to underperform. Did you move to the right from the right fund to the right fund? Did you do it at the right time? There's a lot of what ifs in there, and a lot of things can go right, but a lot more things can go wrong. So it's a very risky move to do any kind of swing trading, whether these swings involve going from stocks to bonds and then bonds back to stocks on these price swings, or even if you're doing like this individual's doing and moving more heavily from one stock fund to another stock fund. This is still a form of swing trading ultimately. And you're seeing the effects of it right here. The individual didn't even perform as well as the S fund, and the entire time he was invested was always in the C and S funds, except for a small point in time where he had 10% and only a mere 10% in the I fund, which really didn't hurt him much there. So, all right, so those are some of the considerations you really should be making when you're dealing with your PIP. I don't want you guys getting depressed that your PIPs are too low, because again, you might not be comparing it to the right thing, or it might not really be as low as you think it is, because let's say you might actually already be invested well. It's just what's going on with share prices. All right, so I'm going to close this. I think. All right. I want to close this out here by discussing some ways that you can improve your PIP. Okay, the first one here is focus more of your money on the funds that are expected to perform the best in the future and put less into or avoid funds that are expected to underperform. So like right now, I don't think that right now is a good time to be in the I fund or the F fund. Reason why. I fund, it's the international fund. There's a lot of economic data coming out suggesting that the global economy is weak. It's growing from what I can tell, but it's not in very solid shape. So the growth is a lot more meager or mild, whatever have you, than what we seem to be getting from domestic economy. So, and then as far as the F fund is concerned, generally speaking, bond prices move in the opposite direction of bond yields. Right now, bond yields are kind of working their way down because people are buying it more into the longer term bonds. Yeah, this is outside of the TSP scope, but the fact that they're buying into the longer term bonds, it probably is helping the F fund a little bit right now, but more long term, I don't think that interest rates on bonds are really high enough to be of any real concern for stock investing. And it's going to take higher interest rates on bonds for them to really be attractive enough for a much broader cross-section of the stock investing population to start moving their money from stocks to bonds. Once we get to that point where bonds actually look like a better investment, or like you can get more money out of, get more better return out of your invested money from bonds than you can for stocks, that's the point in time where I'd be heavily in the F fund, probably 100% in it. And that's best done when it's periods of recession. Speaking of that, I don't know if we'll still see it in here. Okay. It's already rolled off. The 2007 returns, 2007 and 2008 returns is what I was hoping to show you, but it's already rolled off the 10-year period. So, and I can show you from that, the F fund tends to perform the best when everything else is doing bad. All right, so that's one of the ways you can improve your PIP. Next one, be careful not to move your money around too frequently. As I elaborated earlier, doesn't matter if you're moving your money from stocks to bonds and bonds back to stocks, whatever, or if you're moving from one stock fund to another. If you keep moving it around, you're going to open the door to potential problems with your performance. As you saw here, 100%, it stayed 100% in CNS funds the whole time, but because the individual made moves from one fund to the other, and it was always basically a step behind the process, they ended up underperforming. Next one, don't diversify excessively. So what I mean by this is don't go to don't have portions of your money in all of the GFCSI funds. If you don't absolutely need to have them there. Some of you are going to want to have at least some diversification. Maybe you're not comfortable with having 100% in stock funds, and I understand that. That's perfectly fine. If you're not comfortable with maintaining a 100% stock fund distribution, whether it be you just don't know what you're doing, or maybe you're retired or near retirement and you're super terrified that you're going to lose your money, that you might really need very soon, I can understand that, but and then that's another can of worms too, but you don't want to be excessively diversified, because the more you diversify, the more you open the door to watering down your performance. Like I say, if you have 5 funds you're invested in, you're going to get about the average of what all 5 of those funds is doing, more likely. The more heavily you focus your attention on whatever's performing the best is what's going to get you the better performance. So, as far as those of you who are concerned who don't want to invest 100% in stocks, as of right now, I would at least recommend, all right, whatever the amount is you're going to put in bonds, just put it in G fund only. And as of current conditions, my opinion is it should be about 30% bonds and 70% stocks. And that will change regularly as the time goes, but As far as this is concerned, having a combination of G, C, and S is probably a better option than having something in GCS, GFCSNI, all 5 of those funds. It's also better than using any of the L funds, because the L funds are ultimately nothing more than basket funds that invest in the GFCSI funds for you. I'll have to do another presentation on that one particularly too, but that's still an example of overlay diversifying. Keep in mind now, these stock funds, they're built-in diversification already. The C fund, they invest in the S&P 500. There are 500 companies in there. If one company goes bankrupt, so what? The S&P Standard & Poor's is going to replace that company in the index and put a different company in their place. As we actually just saw this quarter when PG&E declared bankruptcy. As soon as they declared bankruptcy, S&P took them out of the index and replaced them with another company that's in better shape. All right, S fund. There are over 4,000 companies in that fund. That's an all market cap index, but it focuses more heavily on the small caps. So that's built-in diversification. And then as far as the I fund is concerned, it's usually in the ballpark of about 1,000 companies in there, and across multiple countries involved. So again, that's another example of diversification. Even looking at the F fund and G fund, those are still built-in diversification. Yeah, the F fund invests in a number of government, corporate, and municipal bonds, among others. And so, if one of those bonds has a problem, there's a whole bunch of other ones to basically take up the slack that whatever the underperformers are doing. But ultimately, any of these are just going to be an average of everything else. The same goes for when you're investing across multiple TSP funds. If you have them across all 5 of the main TSP funds, you're going to always have an average amount, an average performance. It'll never be the top, near the top performance, but it'll never be near the bottom performance either. So that's what you get with diversification. Next one, don't chase a fund just because you see it performing strongly lately. And like I said, this is exactly what happened here. Individual was more heavily in the C fund prior to this and didn't perform as well. And then when they saw the S fund was performing better, they moved more heavily to the S fund. Then when they moved to the S fund, the S fund underperformed. So they moved to the C fund. Now in the C fund, now that they're in the C fund's underperforming the S fund. So what I mean here, they're always constantly underperforming because, and it's not necessarily that any of these moves that individually were bad ideas. It's just the moves and basically and summing up the moves together. In unison, whatever, all of them combine to create just a series of bad moves. Just one single move probably might not have hurt them at all. But I mean, and you can actually take any one single move there, and it probably wouldn't have done any harm at all. But the fact that there were 3 moves in there that kept chasing the strong fund and ended up between then and when the next IFT came, their position ended up not being their stronger position, ended up not being the strongest performer, then this is what happens. So last one here, don't run away from funds just because they've been beaten up more recently. This is especially important for when you see panic selling going on, black swan events or whatever, when corrections or bear markets happen. What happens is people see their account balance dropping, and I call this suffering from a delusional addiction to watching your account balance only go upward. Investing doesn't work that way, guys. You cannot possibly have your account balance always go up. It will go down. The only way you're going to ever see your account balance always go up when you're in the accumulation phase is if you stay 100% in the G fund the entire time. But trust me, that's not a good way to invest. I guarantee you won't be happy with your results at the end of your career. And what money you do have is not going to last you till the end of your life in all likelihood. So you need these stock funds to accumulate the kind of wealth you're likely going to need once you actually are retired. Once you are retired, then that's another story. But most of you here, and this is who really matters, are those of you who are in the accumulation phase, or those of you who are still working and still contributing money to your account and still trying to work toward your retirement. Get your account balances built up. Being overly conservative or making panic moves, moving from stock funds to G fund just because you see your account balance dropping, that's a terrible idea. That's the number one way people trash up their account performance and you can turn $100,000 balance into $40,000 and then make it very difficult to get back to $100,000 just because you made a very stupid move. To be completely honest about it, I don't mean to sound like a condescending jerk about it, but it's when you're moving a G fund just because your balance is dropping, terrible move. Don't ever move your money to the G fund just because you see your account balance dropping. If you don't know why the money is dropping, or why the balance is dropping, you shouldn't even be doing anything. Find out what's going on. Find out why it's happening. Find out how legitimate or illegitimate the drop is first. If you don't know how to, if you can't figure all that out on your own, best thing to do is just don't move it. Because I guarantee you will be very sadly mistaken, and you are going to be very unhappy with your account performance over the long run if you do that. So that's all I have as far as this presentation is concerned. I hope you guys learned some new stuff about PIPs and how to get a better idea of what you really should be comparing your PIPs to, or as I mentioned, the TSP website, and looking at the actual funds performances over the same time frame. All right, so again, don't make bad moves. The less moves you make, the more likely you are to not make mistakes. That's a simple way about it. There's a whole bunch of buy and holder, staunch buy and hold 100% stock fund members in the group. They're going to attest to this. Stay 100% in stocks long term. Don't ever move your money. Trust me, you will be very happy with your results after the end of your career. Now, I'd like to be able to help you get even a little bit better than that if possible, but there's not a guarantee. And if you do make moves, it's going to be, if based on anything that I suggest, then it's going to be a more, hopefully, not very frequent occasions, and it should be very well, well researched and determine what's likely, which fund actually has the best conditions at the given time. But again, any kind of move, even if you're basing a move off of some information that I'm giving you, you're still going to open the door to possible problems with your performance. Okay, so if you stay 100% in C fund and or S fund long term, you're going to be very happy with the results over the long term. All right, and don't worry about what your PIP numbers look like from month to month, because as you saw here, you're probably comparing them to the wrong thing, and there are a lot of things that go on there that impact what's going on with your PIP. All right, that's all I have for now. Please add whatever comments, questions, whatever you have. If you need help with getting, if you believe you're making good moves and you're still not sure about why is your PIP so low, first compare what you have to what I showed you here on the TSP website, what the funds are doing themselves during that same period. If you're still underperforming the same funds you're focusing on and you're not quite sure why, and you need a little help understanding what mistakes you're making, please don't hesitate to let me know. It doesn't matter if you post it as comments in the QOD post, send me a PM or whatever, or you can even send Deb a PM. She's very helpful with all this too, but I know Deb always has a lot going on too, so I don't want to overwhelm her. So, like I say, I am here to help you if you need it. All right, that's all I have. Hope you enjoyed this. Thanks.